Hey guys, what is going on? Welcome to the video. So in this video, I'm going to be going over 3 stocks I'm looking to play and trade this upcoming week. Also going to be going over last week's picks, how those stocks performed, and my plans and updated thesis on those moving forward, and then just overall what I'm looking to trade in this volatile market. Alright, so without further ado, let's go ahead and look at last week's picks. Alright, so last week's video was based on penny stock trade ideas. So the first play we talked about was INCC. This is the trade based on the upcoming catalyst of that merger date on May 30th. So earlier in the week, we got a run up, hit a high of 0.0034, was up close to the 50% from the call out. It then did trend down the rest of the week and is right back at that 0.0023 level. I still have the same thesis on this one, looking for that run up towards that date. I do think we get a larger run than this, so I'm personally still holding on this trade. So next up we talk about Xfuels, ticker symbol XFLS, was pretty flat in the week until we got that run up on Friday with the 15% pop. This is a longer term swing for me personally, looking for the breakout over 6 cents. Currently up 10% in the past week, is looking good and holding the trend. And I do think we get a breakout within the next couple weeks on this one, as long as the trend holds. And then finally, I talked about Capstone Companies, ticker symbol CAPC. This one that had their earnings and their starting sales of their smart mirrors. So we should get an update on that on May 17th when they're expected to have their earnings. And judging by their last earnings where we got the run up past $2, I do think the same could happen with this, especially with the excitement of their full rollout of their products. And this one closed up 12% for the past week. So the good thing about penny stocks and OTC stocks in this market is the fact that they don't follow the overall indexes super closely. So if growth stocks are dipping, if big tech is dipping, these kind of trade by themselves based on their catalyst. So that's the good thing about OTC stocks and penny stocks. In this current market, they are always high risk, of course, but in this video, we're going to be going over one value stock, one that is very safe no matter what happens with the market, in my personal opinion. And we're also going to be going over 2 growth stocks that I believe are heavily oversold and due for a pretty nice bounce back within the next couple weeks. Alright, so without further ado, let's go ahead and get into the first one. So the first oversold growth stock that I'm really liking to set up on and the bounce back potential is Draftkings, ticker symbol DKNG. Just in the past week, this stock is down about 8% and down about 40% from highs overall. So Draftkings is a growth company. If growth stocks do keep getting hit, we saw a nice bounce back on Friday, but if the trend does change back to bearish for growth stocks, this one could dip some more. But if the market does stay steady and we do see a further bounce back for growth stocks, I do think that Draftkings is primed for a pretty nice move. So first off, taking a look at the technical chart, we can see that it is in this pocket of support between 40 and 44. And on Friday, when we got that bounce back, it popped 10% and is back above all these support levels. So moving forward, I look for that 42 to 44 range to hold as new support. And with that engulfing candle, it does indicate a change of trend a lot of the time, and also does have some gaps to fill without any resistance. So if the overall trend does change and we see a bounce back in growth plays, I think Draftkings fills up and bounces back to that $50 level as the next resistance. There's also no reason for the Draftkings dip besides the overall market dipping with growth stocks. We can see at their last earnings, they killed estimates. Loss per share was expected of 42 cents. They only lost 36 cents per share, and they beat revenue estimates with revenue coming in at $312 million compared to the $236 million in estimates. And they also did beat the estimates with monthly active users coming in at 1.5 million versus the estimate of 1.31 million. So there's no reason that Draftkings did dip this far. The chart is primed for a nice bounce back. And as long as the market does stay steady this week, I think we see Draftkings bounce back to $50 per share. Alright, so now getting to the next growth stock I'm looking to play this upcoming week, and then we'll get into the value stock after that. So the next growth stock I'm looking to play is Fisker, ticker symbol FSR. So this is another heavily oversold stock, another one that has dipped along with all the other growth stocks. It's down over 50% from highs. Current stock price is sitting at $10.50, and highs in the past was around $30 per share, so down huge from highs. And with all these other hyped EV companies, a lot of these companies have a lot of expectations and a huge market cap. Fisker right now has under a $3 billion market cap. Companies like Lucid Motors, that already has a $30 billion market cap. While that does have more upside, it is still more of a startup company like Fisker, and Fisker is valued at 1/10 of the valuation of a company like Lucid. So this is trading at a pretty cheap valuation compared to a lot of these other EV startups that may be a little bit more hyped up. Alright, so now getting into the technical chart on Fisker. First off, we can see that it has been oversold and it is starting to bounce back after being oversold. So the last time we saw this stock heavily oversold on the 1 year, 1 day chart, it bounced back from 8.7 at its lows and bounced up to $20 per share. The next time we saw this one oversold, it was sitting at $12 per share. It bounced back to $16 per share. Now it is currently finally bouncing back from being oversold once again, bouncing from around $10 per share and is currently sitting at $10.50 and does have a lot more room to bounce and a potential breakout setup out of this falling wedge. So taking a look at the hourly chart, we can see this has been on a steady decline, but it is starting to test this breakout out of the falling wedge. falling wedge patterns are usually primed for reversal when it does break out. So when this does break out, I do think we get a pretty nice reversal, potentially pop back to that $15 to $16 range if this does play out. So Fisker also had big news come out on Friday. They signed a deal with Foxconn to build electric vehicles, which is really big news. Foxconn is a big and established company valued at over $80 billion. Foxconn manufactures everything from the iPhone to the Xbox, so this is a very established manufacturing company. So with Fisker, the production will begin in the US by the end of 2023, so they do have a long way to go, but they do have a lot of stuff under production as of right now, and the new vehicles that they are working on will be priced under $30,000. So they're trying to build this car for the masses. So with Fisker, it is setting up very nice for a short-term breakout out of this falling wedge, and it is also sitting at a very fair valuation compared to the sector. Very fair, very cheap valuation if you're looking for a longer-term investment. Now, of course, any of these EV companies will always be high risk, high reward, but Fisker is priced with the best of them at this valuation. All right, so now getting to the next stock I'm looking to play. This is ViacomCBS, ticker symbol VIAC. Now, this is the very cheap value play and fundamental stock. So with Viacom, we know the whole disaster that happened with Archegos, which sent this stock tumbling down from $100 and now sitting in the high $30 range. And I've talked about this stock a lot in the past, but this valuation is just so cheap, I'm talking about this once again. So taking a look closer, the forward PE on this stock is 9.28. The price of sales is under 1 at 0.93. The revenue that this company brings in every single year is more than their entire market cap. Now, they're not making that money, but the money that's flowing into the company, that is more than the entire company is valued at right now. So like I was saying, the revenue is sitting at $26.2 billion per year with a market cap just at $25 billion. So already more revenue than the market cap. Quarterly revenue growth, it is a growing company. It's not a high growth company, but it is a slow grower after their acquisition of CBS a couple years ago. Gross profit of $10.29 billion, EBITDA of $5.2 billion, and the net income, which is the money, the pure profit that they are making, is $2.7 billion per year. Now, the only negative fundamental thing with this company is they do have more debt than cash. Cash sitting at $5.5 billion, debt at $19.3 billion. The majority of that debt is long-term debt, so it's nothing that they have to worry about anytime soon until years in the future. But it is still an overall negative for the value of the company, but that is the only negative fundamentally wise. So they recently did have their Q1 earnings of 2021, and they were great earnings. So revenue of $7.4 billion increased 14% year over year. EPS killed it as well at 1.52 earnings per share compared to 1.12 a year ago, and beat the consensus estimates of 1.23. So they also did gain 6 million premium streaming subscribers across Showtime and Paramount Plus to finish the quarter with a total of 36 million subscribers, and that drove a 69% increase in streaming revenue per year. Now, the fact that they beat estimates and didn't impress on these numbers, that is huge because we see other giant companies such as Disney Plus, they missed estimates on their growth, and also Netflix, they also did miss their subscriber estimates. So it is huge that Viacom is beating estimates in the same streaming space. Compared to Netflix and Disney Plus, two of the biggest players in the space, their growth is slowing down, while Viacom's is still going up at a rapid pace, and they're beating estimates compared to losing estimates on those other two giant companies. Just taking a look at Disney Plus numbers, they reached 103.6 million subscribers, up from 94 million at the previous quarter, but the analysts were expecting a tally of around 109 million, so they did meet those estimates and not growing as fast as people were projecting. Now, also taking a look at a company in the same sector as Viacom's is, let's take a look at the valuation of Comcast. The same sector, it's a media and technology company, broadcast television, entertainment, and more. So Comcast is currently valued at $260 billion, and the forward PE, which is important, this is sitting at a 20 forward PE. The company isn't even growing as fast as Viacom's is. So Viacom is essentially trading at 1/2 of the valuation as Comcast is. With the forward PE, Viacom's is under 10, and Comcast is over 20, so that's literally 1/2 of the earnings per share. You're getting 100% more investing in Viacom's as you would investing in Comcast. So the valuation at these levels is an absolute steal compared to the sector, compared to the streaming. Whatever you want to do, Viacom's is a great valuation where it's sitting at right now. Now, taking a look at the technical chart, let's zoom out and take a long-term approach to this. So this is the 10-year chart, and it is sitting right in this range of support between $37 and $40. And each time it has tested this support level, except for the COVID crash. We've seen the stock bounce off 4 different times in this range of support in between $37 and $40 per share. So we saw this stock take off with the leverage of Archegos, and now it is back in this range of support. And I do think we see a bounce and reversal off of this range of support like we saw the past times it has tested this. So it's still consolidating in this range. The stock isn't going to be a fast mover, but when the market realizes the valuation that this company is, I think it's a slow trend up, whether the market's doing good, whether the market's taking a dump, whatever's going on, I think Viacom's is going to be very steady. Just taking a look at the price action from last week. We've seen the market have some very big down days, and while the market was dumping, we saw Viacom just holding steady. It's just consolidating between this $37 level and the $40 level as short-term resistance. When it does get over 40, I think we see the stock break out and have a slow trend back up to that fair valuation range, which in my opinion would be fair valuation, which would be around a 12 to 15 forward PE. That would be a fair valuation in my personal opinion, which would make the stock around $55 to $65 at a fair valuation. And that's my personal opinion, but I do think we get a slow trend back up, and in the long term, within the next 6 months to 1 year, I think we see the stock trading 20% higher in the least, and on the upside, I think we could pretty easily see the stock up 50% from where it's at now. A lot of the average forward PEs for value stocks, like they're considered, a lot of the average forward PEs is around a 15 forward PE. Viacom's is trading at a 10 forward PE. So just from that measure alone, I think we see Viacom's have a slow trend back up, like I've been saying. Very safe to put money in this current market condition. Alright, so those are the stocks I'm looking to play this upcoming week. I hope this video did provide value to you. If it did, it would mean a lot if you like, subscribe. It does help me out a ton, and I would greatly appreciate that. Also, if you're interested in joining the private Discord chat, getting alerts whenever I buy and sell a stock, you can ask me any questions. I send nightly watch lists out for trade ideas. If you're interested in that, the link is down below for the Discord chat. And hope you all enjoyed the video. Make sure to trade smart this week. Good luck to everybody, and let's get rich.